Welcome to Protect Your Assets Market Briefing. I'm your host, David Hollander, also known as the Sandman. Now let's get started. Relatively quiet week in the market. We had the Dow off 0.1%, still up year to date 8.7%. S&P off slightly 0.3%, year to date up 13%. It's incredible. NASDAQ off 0.7%, up year to date 16.4%. International index still the hero, down 1% this week, but year to date up over 20%. And the 10-year Treasury holding steady at 4.18%. Oil had the big week this week, up 4.7%, closed at $65.36 a barrel. So over the last week, started getting questions about the economy. And overall, the data that we saw this past week looks like the U.S. economy is holding in there better than expected. We saw the second quarter GDP growth. Remember, growth is what we're looking for. If growth starts to stall or roll over, that's a problem. And it was just revised last week higher by 3.8%. And the forecast were at 3.3. So we were better than expected on growth. That's very good. And the consumption rates, this is us going out and buying stuff. This drives about 70% of the economy. This came in above expectations, 2.5%. Very healthy. Again, forecasted at 1.7. So you have growth looking pretty good overall for the market. And all the data, looking at it right now, paints a picture of a consumer that is healthy and is spending money. And so what do we think is going to happen in the third quarter? That's the big question. And I was just looking back at the April. Think back that way. April lows, S&P is right now up over 30% from the lows of April. We haven't seen a 2% or more pullback since then. And this is all being driven by momentum and some good news that's been coming out. And so this could drive markets higher, but it is September 27th. We are about to enter into October, which traditionally is the month. I remember October of 2008. You remember those? Jeez. So typically when you enter in these times, especially right now, we don't really have much coming in the next few weeks until mid-October in terms of news and data that we can look at. And we do have the dreaded U.S. government shutdown approaching us quickly. October 1st is the date that's supposed to happen. And if Congress doesn't pass the stopgap measure, which we saw years ago, remember, it just wasn't too long ago when everything just sort of stopped and all that news. So that could cause the pullback, a little bit of volatility. How much? Maybe 5 to 10%. I just don't expect a more severe correction right now, given the data that we're seeing and the underlying strength of this economy. So what should you be doing right now? What should you be thinking about at this moment in time? Well, first, you want to make sure that your investments are adequately diversified for your needs. So if you're entering retirement, you're in retirement, you're expecting a certain amount of money every month, now would be a great time to look and see what's creating that income. And if it's not consistent or steady, you might want to adjust that a little bit. You might want to look at other ways that you can create income that would carry you through any sort of volatility that could last longer than, say, a year. If it did, what would you do? So that's the first thing. It would be a good time to start taking some profits, moving them around, creating that income. And when you're talking about the exposure on your fixed income, you want to look at investment grade. Look at investment grade bonds. Also look at some fixed annuities right now, have some very good rates. While rates are high, these assets can hold up better in market pullbacks than equities do. The other thing you want to do, second, would be, we would say if you have any outsized positions, say in cash right now. A lot of people are sitting on cash. It was too late. They didn't get in. Market moved, so they're still stuck there, sitting there. I think now could be a good time to think about investments in maybe a dream list of stocks that if they pulled back, you would buy into them. Certainly the high-quality bonds I'm talking about with yields, and as I'm talking about fixed indexed annuities, those have some very good rates right now, with rates being high. You could consider adding some of these to your overall exposure, and that would just lower your overall volatility and risk. And by doing that, if something came, you'd be in a better position Over the long term, cash returns typically underperform these other asset classes, and they may not keep up with inflation. And that just means that now is the time to be thinking about alternatives that could protect you while the markets are still pretty good overall. So take a look at it. Don't ignore it. I know it feels good. Everything looks pretty good. But these are the times to be clipping the coupons, picking the ripe fruit. You know what I mean. Spend some time and do it.
You can hear the Protect Your Assets market briefing on your favorite podcast app or as an Alexa flash briefing. Just search for Protect Your Assets market briefing. Links to subscribe free wherever you listen are at libertygroupllc.com/PYA briefing. The following program is paid for by Liberty Group, and the views and opinions of the host do not represent those of the station or its ownership. Investment advisory services are offered through Liberty Wealth Management, an SEC-registered investment advisor. Legal information provided on the air is not intended to be a substitute for callers hiring their own lawyers to advise them about personal legal matters. The information provided is general financial comment and cannot be relied upon for your specific financial situation. Investing involves risks, including the risk of loss of your investment. Please consult with a financial professional before investing. California Life Agent number 0B48569. You're listening to the Protect Your Assets Radio Network.